Hello, everyone. Welcome to episode 37 of Great Quater Guys. I'm your host, Andrew Cox, here with my co-host, Kevin Hill, and we have with us Seth Holm as well, one of the OG hosts. He'll be joining us here in a moment. Kevin, how are we?
We're doing great. We're doing great, Andrew. I'm ready to get the show started and kicked off. And thanks again to Carrier Direct for all their research contributions to our show today.
No doubt. All right, episode 37. I had to dig deep on this one to find a number 37, but I've got one for you. Hall of Famer Doak Walker.
Doak Walker, yes.
1954. I think he won the Heisman back in the day. Do you know where he went to school? Trivia?
Auburn, I think.
SMU. Yeah,
SMU. That's
random
right.
guess. But yes, the Doak Walker episode for you. Also, this is interactive. We are live on LinkedIn right now, and I wanted to make it more interactive. So if you guys are watching and you have a stock that you want us to talk about or an idea that you'd like us to discuss, if we know anything about it, we'll try to talk about it. So throw it in the comments somewhere, and we'll try to get to it at some point in our 30 minutes here. Let us take a quick look at that Bank of America consumer spending data that we've been checking in on every week. Total card spending seems to be picking up a little bit. We see 2 or 3 double-digit days up over last year in the latest report. However, there are some divisions here that have dropped off significantly. The department store spending has slowed a lot. You see that there was probably a lot of pent-up demand there in June. The July numbers, the end of June and the beginning of July numbers are slowing down a little bit. The lodging and gas spending data has slowly been improving. That shows that people are out and about. Which is also a good thing. And then again, online electronics, everything online is doing pretty well. Furniture and home improvement have continued to outperform. So you know what we're doing there. We think things are getting a little bit better. But let's hop into what I'm going to call a new segment. Okay, this is an ode to Dan Le Betard and his father Papi on Highly Questionable. They are Cuban, of course. My mother's Cuban, so we have a little connection there. I love Dan Le Betard. I'm going to do an ode to him. They do a fun segment called Sí o No, and I give you an idea, and you say whether you're interested in that idea or not. So we'll run through these. We're going to call ours You Care or Nah. That's what we're calling this. So first one, for Kevin and Seth. Bill Ackman and Pershing Square have submitted a prospective and are seeking to raise $4 billion for a special purpose acquisition company. Kevin, you interested or not?
I'd like to see what Ackman buys. I would like to see. He's had his hits and misses. Sears might be a miss, but I think maybe if he bought some distressed companies during this time with the $4 billion or one distressed company, I think it'd be interesting. And let's face it, whatever Pershing Square does is interesting in my book. So I'm a yes.
Seth, what about you? You care or nah?
I care, yes. So this is going to be the biggest SPAC of all time. It's going to raise as much as $7 billion. It's going to be a little bit different. He has stated that he wants to buy a minority stake in a private large capitalization company. So Ackman is kind of going back to the basics, that made him successful. He was on David Rubenstein's show that I would recommend if you go back and watch that. But, he's looking for simple, highly cash generative businesses, which Kevin likes. And so it'll be really interesting to see what he goes out there and buys. Yeah, so I'm definitely interested.
What industry did you say, Seth? I missed that.
Yeah, I don't think it's industry specific, but
profile.
Basically, a minority stake in a large cap predictable business was the quote that I read in a Barron's article. So, but that's basically what he invests in now. So think things like, Starbucks, railroads, Chipotle, stuff like that right now.
Well, lovely. I'm interested as well. I'm actually with Seth on this one. I'm excited about the big SPAC. I think it's going to be very interesting. SPACs are becoming so popular nowadays. We were talking offline about how SPACs used to be kind of a seedy way to get into the public markets, but are now, because of COVID, kind of gaining some respectability there. But all right, we'll move on to the next one. Number 2, Elon announced that they would be dropping one of the 4 models, one of the 4 options of the Model Y. It was one he's saying it's going to have too low of a mile capacity. It's going to have less than 250 miles. Seth, you and I are the big Tesla bulls here. You care or no?
I don't really care that much. So yeah, just for background, Tesla usually has a standard range and then a long range, and the long range is obviously more expensive and you get more battery mileage out of that. I am more interested in the things I've seen the last 2 days. So Tesla is likely to be expanding into India in 2021, with likely in the form of one of those hatchbacks. There's been sources that have said that that's going to happen. And they're also talking about building a second, they're not talking about it, but this got leaked to the media, that they're building underway right now. They're building a second gigafactory in China. So those sort of more interest me. I think the demand for the Model Y, most people probably would have gone with the long range anyways. So.
Kevin, you don't care much about Tesla. You care about this Model Y getting canceled or not?
I don't, and this is not a dig on Tesla whatsoever. It's a car company. It's like any other company with multi-brands. You have your superstars, you have your dogs, you have your in-between, the four quadrants from some Boston consulting firm.
Yeah, BCG.
So it's just normal business. So it's not really a big deal. If it's not selling, it's going to get cut.
Yeah, I am going to care about this one as a Tesla stockholder. I am happy that they are dropping this model because he doesn't think that it would meet their requirements. That means they're keeping their requirements high as they have. They produce a good product. So I do care about that. I'm glad they're doing it. All right, moving on to, we got actually a bunch of car things to rip off here. There's a lot of car news. We're just going to rip through them. So Rivian, the electric car maker based in Michigan, they've been around for about 10 years but have yet to deliver a car. They are backed by Ford and Amazon and some other massive companies. They just secured another $2.5 billion in funding. Seth, you care or no?
I care, and I'll tell you why. I hardly know anything about the company, but I know Jeff Bezos is a big bull on it. He went and visited their factory in Michigan, and then ordered 1,000 of these for Amazon for their cargo delivery. That, plus I heard this week on a podcast that Ron Barron at Barron Capital is a big investor in this, and why you should care about that is he was, I think, the single largest investor in Tesla, and he's been in it since the IPO. So he knows his electric cars, and if he is an investor in it, it's probably worth looking at.
Kevin, $2.5 billion to Rivian, you care or no?
I think Seth just talked me into caring.
Okay.
I think he did. So is that the one with the really nice SUV?
Yeah, so they came out with I think it was about 18 months ago. They have this beautiful emerald green with circle headlights, hollow circle headlights. It's a gorgeous car, really.
It is, yeah. We were looking at it a while ago offline, and it is a gorgeous car. So because of Seth, I'm interested. Yeah, it was a no, but he turned me into a C.
Well, good. I care as well. I think Rivian's a good company. They have strong leadership. They've gotten money from Ford and Amazon. Like you said, Bezos is involved. They've got a lot of smart money behind them. That's the big point here, is that they haven't delivered a car, but they've got a lot of smart money. So I do care about some more smart money going into that pocket of theirs. Another car one. Here we go. This is Fisker. This is another electric car company that had made a splash about, I guess it was 8 or 10 years ago. They were making very high-end luxury electric vehicles. They were kind of competing in that Tesla Roadster area there for a couple years. They've gone through some sort of management change. They are now rebranded as a different Fisker Automotive. They've kept the Fisker name. But in any case, they are going to go public via a SPAC later this year. Kevin, you care or not?
No, I don't. I don't really care. It's another electric vehicle that has yet to produce an electric vehicle, right?
Yeah, they've sold a handful, like a few thousand,
right?
not very many. So
it's another SPAC. SPACs are hot right now, as you let off the show stating, but I can't really get excited about it. So I'm not really very interested in it, and I'd never really heard of them all that much before this, just a few times. So it doesn't really change my opinion.
All right, Seth, you care or not? Fisker going public?
No, I don't care. I agree with Kevin. We are sort of getting this both SPAC and EV overload here because I think everyone's trying to take advantage of Tesla's run and valuation here. However, I did see that the founder and CEO, I guess, has this is very little research, but I think he's pretty reputable for his design work. He did something with the BMW Z28 and the Aston Martin. Is that it?
Yes, you're correct. Yep.
Yeah. So I'll be keeping an eye on it, but no, I don't care for investing purposes. I'm not interested.
Yeah, I'm not interested in investing purposes either. They're a very small company, about $2 billion. I think they make cool-looking cars. I've seen them. But another point to note about that, everybody kind of jumping on the Tesla tail here, is that people wonder why Tesla's valuation is so high, but they're the only electric car maker, at least in the U.S., that has set out, we're going to make these cars, and they just actually produce them. We see Fisker's come out with models. Rivian came out with that model 18 months ago. We haven't seen any of them actually deliver on what they're going to do. So no one, that can see why Tesla's run up the way it is. All right, another car one for you. GMC is bringing the Hummer back, Seth. We've seen that this was coming back. We heard about it. I think they've released a photo now, but it's going to be in electric fashion. It's coming back. We won't be here till 2022. But Seth, do you care about the GMC Hummer coming back or not?
No, I do not. I think Hummers, are the most environmentally unfriendly car on the planet, in their pre-existence. And
you got to appreciate the irony.
And then, just the amount of power it's going to consume to charge those, I can't even imagine. So, no, I don't care on the Hummer.
What about you? You care about the Hummer?
I do, yeah. I do care about it because I'm sitting here looking at a picture of the model, right? You can see this. You've seen it before. It is a gorgeous truck. I mean, it's like the Badger, right? I'm not a fan of the Cybertruck whatsoever. Dooner, sorry, just not a fan. You can have your Cybertruck. The Badger looked really good. This Hummer looks really good as well. I think it'll be more popular than a Nikola Badger. So yes, I do care.
I care as well. I think Hummers are cool. I always did. I always knew that they were gas guzzling and disgusting for the environment, but I think they're cool cars, and I think the new ones are going to be really cool too. You're probably right, Seth. I can only imagine the energy that it's going to take to power that thing, but it looks cool, and I'm here for cool cars.
It's the same amount of energy as any other pickup truck out there, and you need electric pickup trucks to really capture or really turn the market,
I guess
right?
I say that because I know how heavy Hummers are.
Well, and it's not a Hummer, right?
Well, yeah,
it's
I think they're coming back with multiple. They're coming back with multiple models.
So the actual Hummer?
Yeah, I think they are going to come out with one that's kind of similar to the H3, the smaller Hummer that they had.
Then I don't care about that.
But in any case, another company that's come out with multiple models of an old car, the Ford Bronco. We talked about it last week. It finally got released. I believe it was last night with some really dope videos shot all over this crazy, seemed like Wyoming countryside, which was really cool. But the first visuals were again released last night. Seth, you care for it or not?
Yeah, I do care. I mean, as we talked about last week, I think it's a nice growth catalyst for Ford. And I haven't checked back in since last week, but I saw a picture. It looks really nice. It's, competing with that Wrangler. And I think it crashed the website last night. So obviously people are interested. So I do care on that one.
And Kevin, what about you?
Yeah, I definitely care about it. It's a gorgeous car, both of them, right? Or truck or Jeep, right? Which I'll segue into in just a second. The Wrangler competitor, it looks really nice. I like the SUV too. The SUV, and talking about nice round headlights and kind of a throwback type of spirit.
The front is beautiful.
Yeah, and it's the company that really should care about this is Chrysler and Jeep.
Should be shaking in their boots, I think.
Yeah, because if that's their only profitable line, like you said last week on the show, then I would be quaking my boots. So that's I care about it, and Chrysler, Jeep, Fiat, whatever they're called these days, Daimler, should care about it quite a bit too.
Yeah, I care too. I think they look gorgeous. I'm with you, Seth. They're going to be a good vehicle to growth for Ford. Let's get on into our main discussions here. The first one is Walmart. We saw their announcement of Walmart Plus, which is their aim to take down Amazon Prime. This is a $98 per year. You get same-day delivery. You get some fuel discounts, and they have some other perks as well. I think they're going to keep introducing perks to this, especially maybe some discounts on food, some things to really drive grocery sales as well. But just to begin with, Seth, you follow this market better than the both of us. So what do you make of this Rundle, this reoccurring revenue and subscription bundle? Can they steal any of the Amazon fans here, or is this? What do you make of it?
By the way, is Rundle their term or yours? I hadn't heard that
The
yet.
Rundle is a Professor Galloway term. I stole that from him. Yeah.
I don't know. I might change the sound of that one.
Yeah,
but,
Rundle.
So a couple thoughts on that. I think it's a very smart move on Walmart. It kind of makes you wonder, where they've been, why this has not come out sooner. But I think it's a great value proposition at $98, and it's actually I would think it's an Instacart competitor as well, because you're talking about same-day grocery delivery, unlimited, including. I assume you still need to tip. but that's a nice benefit there as well. And then if you look at Amazon Prime, I can't remember the exact number, but it's over 100 million households, which is basically, I think that's a global number, but Amazon Prime basically has almost every household in terms of the middle and upper echelon incomes in the United States. And I think Walmart is a little bit more in tune with both the rural and the lower income community. And so I don't know that they're going to, if many of those customers choose to adopt that, I do like it, and they may not even have to steal them away from Amazon. Although I think there will be maybe a slight, share that they'll take from Amazon. But I really like it from an investment perspective because, it's fairly obvious the businesses in the marketplace right now with recurring revenue and that are technology oriented and, to go with the Shopify announcement that they made, I think these are all valuation accretive exercises that they're going through. And if you look at Walmart, it's growing again and it's all coming from digital. And you're talking about a stock, rather than some of these stocks that everyone says is in a tech bubble, you're talking about a stock that trades at, 0.7 times revenue and 25 times earnings. So if you can, and not only that, but this subscription product basically ensures their long-term viability and existence in so much as that there's low churn and a lot of people sign up. So I think it's a smart business move and it should add value to the company, the stock as well.
So as you said, all of these partnerships, these tech investments, they are value accretive to Walmart. But what do you say to these goofies out here saying that Walmart is the next tech stock, Seth?
I'm never surprised by anything in the market. I could buy into that. And in this market, if you think about it, for all that Walmart needs to do to double is, 0.7 times, just to put that in context on revenue, that would be a tech stock that's going out of business. That is the bottom of the bargain bin. And so if you can even get a 1 or a 2 times revenue multiple at Walmart, you're talking about 50 or 100% upside for the stock. So I can see where they're getting around with that. There's a similar thing going on with Disney. Now, Disney is basically a COVID short. I mean, every single one of their businesses are right in the middle of COVID. But if COVID hadn't come along, you would have seen a similar transformation and valuation re-rating higher in Disney because of their streaming and Disney Plus. So I think it's a very smart move. And I don't think they're crazy. I wouldn't be surprised at all if Walmart goes on a run. If they come out and the numbers that they release early about how many people have signed up and their usage and all the key metrics look good, I think the stock will start to fly. That would be my guess.
So, Kevin, you were the one that brought this conversation to the table. What do you make about people calling Walmart a company with 12,000 physical stores, a tech company?
So to start with, I'll answer the question in just a second, but to start with, Mark Solomon, one of our contributors at FreightWaves.com, wrote about this and published it this morning, and there's some interesting points. It goes along with what Seth was saying about the market segmentation, right? The upper middle income homes are on Amazon Prime, but not so much rural, low income earners. So it's a very interesting point that, and Solomon goes into it in his article as well, is that they don't really need to steal any market share from Amazon for this to be a really good business move for Walmart, right? So there's a lot of stickiness in Amazon Prime. I don't think anyone's going to cancel their Amazon Prime membership and take out a Walmart.
No, I'm certainly not.
There'll be some that will take out both, right? But there's a huge market out there that's still untapped, and he goes into that. He goes into that quite well on that. On the tech side, I have a question for Seth on that. Is whether they are a tech company, I think they're putting the foundation to, like Disney is putting in the foundation to where they might be able to be a tech company or a tech stock pretty soon. And part of that is the Shopify partnership, right? Mm-hmm. So Seth was saying is 0.7 times revenue is what they're trading at. What kind of revenue multiple is accretive with that Shopify partnership? How should an investor value that? Because I think that would add value. It would add value to Walmart's and their 0.7 revenue trading. What do you think about that, Seth?
Yeah, so a couple things. So I think Shopify, just to put it in perspective, trades at about 50 times forward revenue right now. And Amazon trades at around 3 times, and that's that's up from where it used to be. It used to trade, I think, between 1 and 2 times forward revenue for a long time. But then when AWS and advertising and a lot of these other sort of higher margin revenue streams came in the picture, I think that, in any case, I think Walmart sets up well. They could be a freight tech company, right? So I think very few people in our business would argue that Walmart's logistical knowledge and expertise is probably right up there with anyone's. And so in terms of scale and distribution advantages and all that sort of thing. So I think that sets them up well. And then the other thing, just if you think from an investment perspective, what as I think through this on air here, what I really like about it is this is a really good setup, I think, because it's not that expensive of a stock. And you're talking about a company that's extremely defensive. You saw in March, everybody flocked to Walmart when the economy shuts down. So if things go south and we get another double-dip recession or, nationwide lockdowns, Walmart's probably going to do pretty well. And then even if we don't and the economy recovers and reopens, you've got this big sort of call option here with a lot of upside to it. That's sort of how I'm thinking of it. But on the tech multiples, I mean, you can kind of go across the spectrum. It goes anywhere from companies with low gross margins will generally trade sort of kind of in the 1 to 4 times revenue. So if you think about a Wayfair or Carvana, that's more of a 1 times revenue business. But then you can go all the way up to software, and you're talking about 20, 30, 40 times revenue. So, but in any event, it's way higher than 0.7.
All right, so let's shift gears a little bit to one of those tech companies that's going to get a massive revenue multiple here in the next couple weeks or months or years or whenever this company goes public, because we've been waiting a long time for Palantir to go public. I'll give you a little background on this company for everyone watching that doesn't know the name Palantir. It is a very secretive company, but a huge company as well. So it's named after the Seeing Stones in the Lord of the Rings, the Palantir Stones. The mission of the company is to make the West, especially America, the strongest in the world. So what they do, they are a data mining and analytics company. Again, their IPO is forthcoming. They're one of the largest private companies in the country, roughly $20 billion valuation. It has been an exhausting road to the public markets, as I just said. The trend has been for startups to kind of go public as early as possible in the last, or they've gone public quite early. We saw the difference there with Uber and Lyft and some of these companies that waited a little bit longer, but nobody has really waited as long as Palantir. They've been around for 16 years. They've got investment from something that I didn't even know was real. That's called In-Q-Tel. This is the venture capital arm of the CIA. I didn't know that was a thing, but they got money from them 16 years ago. And again, they're highly secretive because they work with government agencies. They work with a lot of national defense agencies of a lot of Western countries. Again, they try to find patterns in the digital haystack, so to say. They try to find the needle. They are credited with locating Osama bin Laden, so they've got some big things on their resume going forward. And Peter Thiel, who is one of the co-founders, he was the first external investor in Facebook. He is a very well-known Silicon Valley guy. He says in a recent interview that Palantir has better tech than the NSA. So that kind of gets you into perspective of what they do. They're a very kind of secretive company, but we're going to know more about them coming forward. The IPO is forthcoming. So I asked you, Seth, are you long or short the IPO perspective? And is it because you think they're a good company to own and invest in, or because you want to see who they've been working with? Or is it something like both?
I think you know the answer to this because you and I have talked a good bit about this. I'm definitely long on Palantir. I think it'll probably be the year's biggest and most successful IPO. This could be the next $50-100 billion tech company, I think, fairly easily. Now, the growth rate, as you mentioned, they've been around for 15 years or so. So the growth rate is not up there with some of the SaaS company, some of the younger, smaller SaaS companies in the 50 or 100% range. But you're probably looking at, call it 20 to 40% steady growth here. And the other thing is, so I read a book by Peter Thiel many years. It's probably been 10 years, but it's called 0 to 1, and it's a very famous book, and I would recommend it. But he sort of raves about Palantir being the next big thing that he's really interested in. So ever since I read that book, I've been sort of watching this one closely and always wanted to jump at the chance. And I do think to invest in it, and I do think that they have, amazing technology. It is highly controversial because they're involved in things like predictive law enforcement, so they can tell. You get into that as 1984 type arguments. They can tell beforehand when somebody's about to, for example, a mass gun shooting. They can figure that out. Or somebody who's about to commit a violent crime. They can figure that. So and then they work. They're also controversial. It's a lot like Facebook. The guy who runs them, Alex Karp, is sort of a very sort of idiosyncratic guy. I suggest people read about him, but and he's very he wants to help. He wants technology to help employment, but they've also worked with immigration and places like that. In terms of, a lot of people say that they've worked with helping the government deport illegal immigrants and stuff like that. So it will be controversial, but I think it's destined to become a very huge and cool company to follow.
All right, Kevin, are you long or short the idea of Palantir going public, and is it because you want to invest in the company or because you want to see who they work with?
I want to see who they work with. I kind of do want to invest in the company too, but I definitely want to see exactly what they do. I've been kind of researching a little bit this morning, and I still can't figure out exactly what they do. I understand that they work with all kinds of different industries. It's a large, $20-25 billion equity or enterprise value. Not really a startup anymore. But I would like to see what they actually do and who they work with, see what kind of risks that they put out in their S1. I'd like to what was his name? Seth Karp? Alex Karp?
Alex Karp, yeah. He was a law school friend of Peter Thiel's at Stanford. And that's how they met.
Yeah, so I'd like to see how he handles a public company. And so that's really my take on it. I don't know what they do. I know it's high tech, a lot of data, probably scary data if you think about it, what they have access to. But yeah, I would like to read the S1.
Yeah, I'm definitely interested in both. I'm certainly interested in who they work with. I think that's going to be just a shed of light on what they do. I'm also really interested in investing this company. I think that they've done one of the benefits of them staying private for so long is they've been able to build up that balance sheet and build up the ability to get profitable. I don't think they're quite there yet, but I think they're very close. They have big positive cash flows. I would like to see them stop working with ICE. They've had their employees had a big kind of come to Jesus meeting with Alex Karp that they should stop working with ICE. He declined that request, but we'll see what happens there. I do think the company's really interesting. I'm very excited for this company. And by the way, if anybody wants an early access to the company, Seth and I didn't mention, but there's a company, Suro Capital, which is quadruple S is the ticker. Seth, I think they own 20% or something. 20% of their holdings are in Palantir.
Yeah, so they don't own 20%. We're not making stock recommendations, even though
Absolutely
we're
not.
kind of turning Andrew into Jim Cramer here. But 20%, they don't own 20% of Palantir, but 20% of their assets
right.
Are in Palantir, and they've got some other interesting stakes. They've got a nice stake in Nextdoor, which is another up and coming huge tech company, and some others. So
there you are. So quadruple S if you're interested there. Okay, we got 90 seconds here. Let's hop on a quick one at the last. We're going to talk about freight volumes. This is a finance and freight show. We've kind of been avoiding freight to the end, but let's throw it in here at the end. Seth, are you long or short OTVI averaging a higher total for the second half of 2020 versus the second half of 2019 or 2018? Thus far, the averages have been very similar through the first half. 2020 has been just higher than 2019 and 2018. What are you expecting? Do you think freight volumes outdo the previous 2 years in the back half of the year?
Yeah, I'm definitely long here. I think it's separated itself recently. It's something like 20% above both. 2018 was a bullish year for freight, but it fell off in the back half, and 2019's easy comp. So you basically have to think that OTVI is going to crash here for it not to. So I'd be long that.
What do you think? You long?
Yeah, I'm long OTVI because dry van reefer exposure. I think the industrials, another story also altogether. I think flatbed tender rejects are crashing right now with shutdowns and stuff. But I think with these emergency supply, grocery stores, things like that,
Yeah, I think that it will definitely outdo it. I think if we go into another lockdown, you're going to see grocery data and everything popping up again. But this has been a wonderful show. Thanks for Carrier Direct. We are on a 6-day, 23.5-hour break. We'll see you next week, guys.